Okay, Bim. Hi folks, Nick Musumba here. Video number 9. I'm going to be talking about the 3 key sales channels for life insurance in Australia: retail insurance, direct insurance and superannuation, and some of the differences between them. Quick background on me: I've been working in personal finance and life insurance for 7 years, so hopefully can help share some of that, some of what I've learned over those years with you to help you make more informed decisions when you purchase your own life insurance. And when I say life insurance, I mean all personal risk insurance: life insurance, TPD, trauma insurance, income protection, the whole suite. Okay, so first thing I need to explain is the 3 different channels. So in Australia, life insurers distribute their products through these 3 key distribution channels, sales channels. Okay, so the first one being retail products. These are distributed through advisors. So financial advisors, insurance advisors. Generally, you're going to get what they call personal advice or general advice before you purchase one of these products. So the advisor will help help you tailor that to your needs. It's quite a tailored, high level of specification product. So that's retail insurance. The second channel is direct insurance. As the name suggests, this is where you would purchase a product directly from the insurer, and you can do this with as little as no advice. You can do it online in some cases, or in other cases you may receive some general advice on the product before making a purchase. Generally, you don't get personal advice when you purchase this sort of product. Okay, so that's direct insurance. And the third channel is through your superannuation fund, which they call group insurance, because it's sold to a group, which is the members of the fund. So with group insurance, in terms of the advice you receive before you make a purchase, it may be general advice. I guess some funds may offer some personal advice as well, and you would own that within your super and pay for that with your super. It's somewhat limited because of the nature of superannuation and the SIS Act and that sort of legislation. There's only certain types or levels of cover that you can get. Okay, so they're the 3 different channels. Now, I wanted to have a look at some data around these different sales channels with you guys. This is publicly available data. It's APRA data. Okay, APRA is Australian Prudential Regulation Authority. Okay, it's one of the key regulators of the life insurance industry, and they put that data up available on the moneysmart.gov.au website. So get this up on the screen. So we'll have a quick look here. So this is the website here. I'll put the link in the notes. But if you have selected death cover, which is the same as life insurance, as an example, you can then go and choose your sales channel. So you've got superannuation, financial advisor, that's retail, or direct. Okay, so if we look at stuff from the top there, superannuation, they basically give you a list of these different data per insurer, but they also have an industry average. So I'll be mainly focusing on the industry average today. But you can see there you've got your claims accepted rate, you've got your average claim time from making the claim to receiving a payout, and number of disputes per 1,000 lives insured. This is number of disputes per 1,000 lives insured, claim disputes specifically. So you've got that data there for all 3 of the different sales channels. So if we look at the industry average for claims accepted for superannuation, it's 98.3%. Then for financial advice retail products, it's 97.7%. And then you've got direct, which is 91.9%. Okay, and you can see that the super and financial advisor streams were pretty similar at about 98 and 97. whereas the direct insurer rate is somewhat lower at 91 roughly, okay, which is pretty typical of the stats in most categories from just a brief look over the data. So then you might as well have a quick look at the claim, average claim time as well. So superannuation, 1.1 months, advice sales channel, 1.4 months, and direct, 2.5 months. Okay, I'm going to pretty much ignore the policy cancellation rate here because the data wasn't provided for superannuation. Okay, so I've taken some of that data and put it in a table here so we can kind of summarize what's available and get a feel for how these different sales channels are performing, if you like, comparatively or relatively. So what I've done here is I've taken the industry average by sales channel, superannuation, retail or advisor, direct. I've taken the industry average, put it in the table here, and I've used color coding here to represent how they stack up against each other. So you've got green would be the most favorable data, yellow being second most favorable, and red being least favorable, okay, relative to each other. So for example, if we go look at that life insurance or death cover claims accepted rate, we've got that 98.3% for the superannuation here, and it's green because it's the most favorable claims accepted rate. You've got retail here at 97.7, it's the next most favorable, so it's yellow, and you've got direct at 91.1%, which is the least favorable, so it's red. And I've done that for life insurance, income protection, and TPD, industry averages for all three of these different categories. So this begins to paint a pretty clear picture, like a visual representation of how these different sales channels are performing. And there's clearly most of the greens in the superannuation, most of the yellows in retail, and direct is all red. There was no data provided for TPD, claims rates or average claim time, etc. The data just wasn't provided. There must not have been enough, I'm not sure. But nonetheless, it's painting a pretty clear picture. This data suggests that superannuation is a more favourable sales channel. It's not the be-all and end-all, of course, but that's how it's looking at this stage. So that's pretty compelling. But I did want to talk briefly about what doesn't show up in that data there, okay? So the first thing I want to touch on is the number of superannuation funds. APRA regulated superannuation funds, there's about 100 or so, okay? I think it's slightly over 100. Advisors in Australia, financial advisors in Australia, there's thousands, okay? So why do I mention this? Because with super funds, the experience that you're going to get is going to be more standardized because there's not as many super funds, so it's going to be more standardized. Whereas the variation in experience you can get if you use a financial advisor is going to be much more broader, okay? You can have very competent financial advisors and very incompetent financial advisors. So if you have a financial advisor that really knows what they're doing and you have a good relationship with them, then the likelihood of a successful claim or a dispute or anything of that nature, that basically any of these statistical categories, it's going to be more likely to be positive. Okay? If the financial advisor isn't very competent, it's more likely to be negative. There's probably going to be a spread of experiences, a greater spread of experiences there is basically what I'm saying. Also wanted to comment on disputes, which is a statistical category here, but I did want to mention disputes per 1,000 lives insured is where you do see quite big difference in the numbers, right? So looking at disputes per 1,000 lives for life insurance via super, you've got 1.6%. I'll show this up on the screen. 1.6%, sorry, not percent, 1.6 per 100,000. Okay, via the retail channel life insurance, 14.8, direct channel life insurance, 28. Okay, obviously there's a substantial difference there between super and retail, and retail and direct as well, I guess. But particularly super in the other two channels. I'm not sure what explains that, but yeah, like I said, it depends on your advisor, heavily on your advisor when it comes to the retail channel. But nonetheless, those are the numbers. Another thing I wanted to mention is that doesn't show up in the data here is that with the retail channel, you do have an opportunity to, like I was saying earlier, tailor the policy more specifically to what your needs are. And when you talk about the flexibility of underwriting in retail, underwriting basically, for those who don't know, is when they assess your financial and medical circumstances and decide whether or not they want to take you on as a client based on that, or how risky you are as a client. Retail insurers can be more flexible in their underwriting sometimes, and offer relatively unique offerings. What do I mean by that? For example, if you were diabetic, some insurers won't offer you cover at all, right? If you have diabetes, type 2 diabetes, or type 1, actually. Whereas with some retail insurers, they can be more favorable with diabetes. And if you actually engage the right advisor who has the right relationship with the insurer, you can even have loadings waived, right? Loadings are the extra cost that they charge you for having an adverse medical history like diabetes. I have seen that specifically in the insurance industry, where a particular advisor or broker is doing enough business where that insurer will say, hey, if you have a client with diabetes, we will waive the loadings and offer them standard rates. Okay, which is when the smallest loading is usually 50%. By definition, that's a 50% gain on costs. All right. The other thing that this doesn't show up is that, or the data doesn't show, is that with retail policies, you have more flexibility in how you can structure the policy, and some of the benefits that are available. Like, for example, retail policies can be owned by self-managed super funds. The other options, you can't do that. You can own it personally. You can have it owned by a business, like a key man insurance. There's quite a lot of flexibility there. And for example, like with income protection, benefit period up to the age of 65. Some super funds won't offer that. Some direct insurers won't offer that. They'll offer shorter benefit periods, 2 years, 5 years, that sort of thing. So there's a few benefits there, a few bells and whistles, more flexibility, more opportunity to tailor the cover with retail policies outside of the claims data there. Okay, I think that's pretty much everything I wanted to cover off with you guys. Oh no, price. I did want to touch on price as well. So, and take this with a grain of salt, but from the years that I've worked in the industry, I've seen a few patterns, okay? First of all, price-wise, direct insurers, generally more expensive, okay? Generally more expensive. There were times where I saw income protection from direct insurers that was cheaper, but usually, if it was substantially more price competitive, it was because mental health wasn't covered, okay? Which would, for obvious reasons, allowed them to price the product lower. But otherwise, life insurance, total and permanent disability insurance was generally more expensive with direct insurers. The lump sum insurances like life insurance, TPD, they were usually pretty comparable between super and retail, depending on the insurer that you're engaging and, I guess, your circumstances, like your age, demographic, occupation, whatever the case may be, because the insurers will have their sweet spots depending on those specifications for the client. Income protection through super, I did see some very competitive rates for income protection through super for whatever reason, relative to retail insurance. So that's pretty much a summary of what I'd seen over the years when comparing different prices from different sales channels. So that's pretty much it, guys. A bit to cover off there, but yeah, I think claims data-wise, superannuation and retail insurance pretty comparable, except for disputes. Superannuation definitely has a leg up there. In terms of tailoring the cover, retail is clearly the best of the three, just simply in terms of tailoring your cover. And price-wise, super and retail pretty comparable, except for income protection. Super tended to be more competitive there. Direct insurance generally not as competitive. So that's it, guys. Thanks for watching.